No, JP Morgan, they acquire the silver short position of Bear Stearns, manipulate the price to below $9 per ounce.
The CFTC's own reports of November 2009 show that just two banks held 43% of the commercial net short position in gold and 68% of the commercial net short position in silver. In gold, these two banks were short 123,000 contracts, but long only 523 contracts. And in silver, they were short 41,000 contracts and long only 1,400 contracts. How improbable is that these two banks attract most of the investors who want to sell short?
JP Morgan is now short approximately 30,000 silver contracts, representing 150 million ounces of silver. This is one of the largest concentrated short positions in the history of all commodities, representing 31% of all open COMEX silver contracts. Another 7 commercial banks are short a total of 35,000 silver contracts, combining for a total commercial net short position in silver of 65,000 contracts. This means commercial banks are now short 325 million ounces of silver that they will eventually have to cover by purchasing these 325 million ounces of silver back in the open market. This could create the largest short squeeze in the history of all commodities. Since the beginning of World War II, the world has consumed more silver for industrial uses than it has produced from silver mining and recycling. 70 years ago, the world had 10 billion ounces of above-ground silver inventories. Today, it is estimated that there are only 1 billion ounces of silver inventories left. Silver is currently only 1.5% the price of gold, despite the fact that above-ground inventories of gold have become much more plentiful than silver. In the first quarter of 2010, the U.S. Mint sold 9,023,500 American Silver Eagles, the most since the coin debuted in 1986, and up from 8,299,000 sold in the fourth quarter of 2009. All U.S. silver mines combined are currently producing only 40 million ounces of silver annually. This means that the U.S. needs to use almost all of its silver production just to keep up with the demand for American Silver Eagle coins.
The fact of the matter is this. The gold to silver ratio of 64 would not be possible unless silver was being held artificially low through manipulation. I don't believe it is possible for the silver that JP Morgan is short to be backed by physical silver. Most likely, JP Morgan is naked shorting silver by selling paper silver that doesn't physically exist.
Are you concerned that the shorts will not be able to deliver if called upon?
No, I'm not at all concerned. For one thing, it's been persistently that way for decades. Another thing is that there are any number of mechanisms allowing for cash settlement. Precious metals are financial assets, and like currencies and T-bills and T-bonds, they trade in the multiples of 100 times the underlying physical.
What Mr. Christian fails to realize is that investors around the world that are holding paper silver contracts believe they actually own the physical silver. There's going to come a time when these investors don't want cash settlements in U.S. dollars, they're going to want the physical silver itself, and this is going to result in a COMEX default.
In June of 2007, Morgan Stanley agreed to pay $4.4 million to settle a class action suit with brokerage clients who bought precious metals and paid storage fees, when in fact it was alleged that Morgan Stanley wasn't physically storing their gold and silver at all. It's not out of the realm of possibility that the Morgan Stanley situation has evolved into an epidemic of banks selling silver they don't have. During the past couple of months, 18.5 million ounces of silver have been taken out of the silver ETF, SLV. With silver prices up nearly 20% during the same time period, it's unlikely that SLV investors have been selling. The withdrawals from SLV have taken place at the same time as large inflows have come into COMEX warehouses. This means we could be seeing dealers who are scrambling for physical silver to deliver to their wholesale customers. If they are having to take their silver from SLV, it could be a sign that very little silver remains in unreported silver inventories. A major silver short squeeze could be imminent. Based on the government's own CPI index, silver's all-time high in January of 1980 of $49.45 per ounce would equal $138 per ounce in today's dollars. If you account for how the government's CPI index understates inflation, silver's real inflation-adjusted high in January of 1980 was $440 per ounce. If we see a COMEX default and a short squeeze as investors around the world demand physical silver, the price of the physical silver could rise astronomically from its current level of $18 per ounce. based on gold's current price of $1,150 per ounce and the historical gold-silver ratio of 16, a silver price of about $72 per ounce could be realistic as soon as JP Morgan's manipulation comes to an end.
In general, I think that all currencies will over time depreciate against precious metals, gold, silver, platinum, and palladium. That in concert, the purchasing power of paper money will go down.
In NIA's Top 10 Predictions for 2010 article that was released on December 21st, NIA said the US dollar was overdue for a short-term bounce from a technical standpoint because more people had become bearish on the dollar than ever before. NIA was right. The US dollar index has rallied in early 2010 from 78 up to a high of 82. This is because the US dollar index only compares the US dollar to other fiat currencies, and it is heavily weighted against the euro. There is currently a major financial crisis in Greece, which has given speculators on Wall Street an excuse to short the euro and go long the US dollar. Greece has a budget deficit that is 12.8% of their GDP, and many people believe a collapse of Greece could take down the euro. Everyone who was bearish on the US dollar in late 2009 is now pessimistic about the euro. NIA believes those that are short the euro will soon have to reverse their trades, which could lead to the euro bouncing along with the US dollar crashing.
Now, I own the euro, as you may know, because...
You're long, but why are you long the euro?
Because there's so many shorts, and because, gigantic pessimists around the world about the euro, so I always try to be on the other side of the trade, if it makes sense. And I figured something would come up to paper this crisis over. Now, I don't think that's good. I don't think it's good for Europe or the euro, but I expected it to happen. I'm sure it will. The euro will have a rally, and then we'll have to see.
NIA believes all fiat currencies will eventually fail, but the US dollar is likely to win a race to the bottom with the euro. Despite all the problems in Greece, the country of Greece makes up just 3% of the total Eurozone GDP. The state of California makes up 13.5% of the US GDP, with an economy that is 5 times larger than Greece. And with every passing day, there is an increasing likelihood that the state of California will soon need a bailout by the federal government.
The currency is much more flawed in the sense that we have gigantic debts, a huge balance of trade deficit, etc. The Eurozone as a whole is much less flawed. I would suspect that the U.S. will have more problems first, and then the euro, but who knows?
In an attempt to add fuel to the US dollar rally, President Obama recently proposed a spending freeze, which he promised will help cut down on future budget deficits. The spending freeze, which will begin in 2011, excludes defense, education, as well as programs like Social Security, Medicare, and Medicaid. Obama's proposed spending freeze is absolutely meaningless. Let's say instead of freezing government spending where it is today, Obama actually cut 100% of all government spending down to zero, but kept Social Security, Medicare, and Medicaid. Our country's current annual tax receipts are not enough to cover the spending. That's right. If the U.S. government got rid of every single department, including the military, we would still have a budget deficit from Social Security, Medicare, and Medicaid alone. With the baby boomers beginning to retire, the growth in entitlement spending will accelerate rapidly over the next few years. The average American peaks in spending at 46 years old, and the last baby boomer will turn 46 in 2010. This means real U.S. tax receipts will decline this decade at the same